So the Federal Reserve has been in the news recently, with especially today with the recent bad jobs numbers, and that the Fed's going to cut rates more quickly to stimulate the economy. But what does all that mean in the context of like monetary and fiscal policy? So to start off with, monetary policy is controlled by central banks, and the Federal Reserve is the United States, Central Bank of the United States, right? Sometimes they call them also the lender of last resort. Versus fiscal policy would be primarily done by Congress, power of the purse, and to a lesser extent, the president, with the ability to sign laws and stuff like that. So that they're going to control taxes, they're going to control how much money the government's going to take in versus the Federal Reserve really controls how much money there is out there. So it's kind of interesting. So, in terms of the many tools that the Federal Reserve has, one of the main tool that they use is called open market operations. That's done by the Federal Open Market Committee, FOMC, right? So, market operations is essentially the Federal Reserve buying and selling securities. So, what does that mean? So, they buy bonds from banks, from member banks to basically stimulate the economy because now the banks have more cash on hand and they can lend it out to you and me to start businesses, right? Vice versa, if they were to sell government bonds or sell securities to the member banks, now obviously the member banks, their money's tied up and they can't lend as much. So that's one of the biggest tools they have. It's like going to be the least impact tool. So it's the least impact tool. It's something they're constantly doing, right? What other tools do they have? They have the ability to directly change the discount rate, which is the rate that member banks can borrow from the Fed, from the Fed's what's called their discount window. And that's something they can change directly. And they actually indirectly change what's called the federal funds rate, which is the overnight interbank borrowing rate for member banks. And that's usually a little bit less than the discount rate because why would the Feds borrow? Why would the member banks borrow from each other when they can borrow for cheaper from the Fed? Which, not always the case, but that's, usually the case. The federal funds rates can be a little cheaper. So the Fed really wants to control that, but they can only do it indirectly, right? By controlling the discount rate and open market operations. What else could they potentially do? They can also do like something more aggressive by changing the reserve requirement. So what does the reserve requirement mean? If you go and deposit $1,000 in the bank's not going to keep $1,000 in the vault waiting for you to come back and pick it up at any moment. They usually have a set reserve that they keep. Let's say call it 10%. So that means that if you were to deposit 1,000 in the bank, they're going to only keep $100 on hand for you to come back and borrow it. They'll lend the remaining $900 out through what's called fractional reserve banking, which again go down a whole different rabbit hole with that stuff. So um, yeah, so let's say if they were to increase the reserve requirement, so now banks have to keep, let's say, 15% on reserve. That means that if you were to deposit $1,000, now the banks have to keep 150 on reserve for you, and they can only lend 850 out to you and me and Bob and everyone else. So that obviously is going to contract the economy, and vice versa. If they lower the reserve requirement to like 5%, that's definitely going to expand the economy because banks have to keep less on file to lend. Now another thing they could do, which obviously that would be even more aggressive, would be like they could change Regulation T. So Regulation T, that's the rate at which basically that allows broker dealers, it's set by the Federal Reserve, to lend out up to 50% of securities value by offering margin to clients. And as long as they have $2,000 in the account, let's say if you want to buy 10,000 of securities, you only need 5,000 of equity, and then you can borrow the remaining 5,000. So the Federal Reserve Board does dictate that they can change Regulation T. So generally speaking, expansionary policy would be, open market operations would be buying bonds from the member banks, would be lowering the discount rate, would be lowering the reserve requirements, and potentially increasing Regulation T, so maybe you can borrow more. But again, that'd be like that. I don't think that's changed in a very long time, so don't worry about that one as much. But versus contractionary policy would be selling securities to the banks. It would be increasing the discount rate, right, and indirectly increasing the federal funds rate and increasing the reserve requirement. And then again, like with Reg T, they would basically lower it, saying, "Hey, you can't borrow as much." So Yeah, these are kind of a couple cool tools that the Fed has to control the economy. They do have like what's called a dual mandate, would be keeping unemployment low and inflation manageable. And now obviously with the job numbers not being too great, the goal is, hey, let's lower um, interest rates so that people can borrow money at a cheaper rate and expand their businesses. So we'll see if that works. Obviously there could be some headwind stuff like AI that maybe is you know maybe the lowering the interest rate is not going to help, but we're going to have to see what happens. We also want to make sure if interest rates drop too much, you don't want, inflation to go out of control where, we had a problem with that. I think it was 2022 or so. So yeah, hope you guys listen in for more and hope you have a great weekend. Thanks.